Welcome to the Bryan Foltice Behavioral Finance Podcast, where we unravel the mysteries of behavioral finance and unlock the secrets to making smarter, more informed decisions with your money. Now, here's your host, Dr. Bryan Foltice.
Okay, three guys walk into a trading card store, and they all walk in and they get the exact same Patrick Mahomes card, and they all pay $500 for the exact card. There would happen to be three of them. They all bought the same card for $500 each. Now, each of these three people made the exact same purchase. One guy will go straight to the counter to the other side of the store, sell it back for $500, and change his mind. He wants to buy a bunch of unopened boxes of the newest football cards. The second guy takes that Patrick Mahomes card, takes it back to his house, and sorts it into his collection with other Patrick Mahomes cards, shuts the binder, and puts it back. The third investor, the third guy, comes in. He takes that Patrick Mahomes card, goes home with it, posts it on eBay, and tries to sell it for a higher price. Same exact purchase for these same exact cards, three totally different motivations. Friends, that is behavioral finance, and that's what we're going to be talking about today, is how psychology shapes our financial decisions. And that's what we're here to do. We're going to use it through the lens of trading cards, which, truth be told, has become this obsession of mine and quasi-addicting, definitely a slippery slope. And we're going to talk later about diversification. So please understand that my trading card collection is no more than 2 or 3% of my overall wealth at any given moment. But it's definitely become a thing that has taken up probably too much time, or more time than I would like to admit, but has become something that not only has gained interest in myself, but is becoming a huge industry, and now is almost turning into this new asset class, alternative asset class, which, even if you're not interested in trading cards, something that you should be aware of, and certainly aware of how different types of people treat these trading cards. So we're going to talk about the three different types of individuals, and we're going to learn about the psychology behind these individuals and their motivation behind basically the same purchase. And so the three different types of, before we get into that, the trading cards, if you're not familiar with it, or if you are, remember these cards. I've got a couple here. I've got the 1986 Fleer basketball cards here in front of me, ungraded. And back in the day, in the 50s and 60s, when they started making these cards, kids would get them, eat the bubble gum that was in them, and then a lot of them would trade them or use them on their bikes, because sometimes if you connected them to your bikes, it would make a cool noise. And so people realized later on in the 70s and 80s that, I wish I would have hung on to those cards, because now they're worth a lot of money, but I treated them as my bike spoke, and now they're not worth anything. Or my mom got rid of them because they weren't worth anything, and they had this regret. And that got passed on to the generation that I'm a part of, who grew up in the 80s, that said, hey, you're going to have these cards, but we're going to take care of them. Don't bend them. And we're going to sock them away, because this is going to be your retirement fund, or this is going to fund your first house purchase. And it wasn't just an isolated population who was, this was basically widespread, where everybody was holding on to their cards, keeping them in safekeeping, keeping them in good condition. And this gained momentum towards the end of the 80s and early 1990s, and corporations started getting on to this trend, and different manufacturers, and so they mass produced all these cards. And we have what is now called the junk wax era. So this is when they just mass produced all of these basketball, baseball, football cards, and everyone hung on to them. And so now you have, fast forward, you have all of these investors who have these boxes and collections of these cards. And basically, because it's so mass produced and there's still supply and demand forces at work, that these people are always disappointed when they find out that it's not worth anything. In fact, I can't pay you anything except the only utility, the only function that these things have essentially are, the only thing I can think of is it would hurt to even wipe my ass with these cards. It's not absorbent, so I can't use it as a paper towel. I could probably use it to start a fire if I wanted to. So that's basically it. That's how much these cards are worth. There's literally no value to those, even if you have thousands and thousands of cards. So you went through that, and then it subsided a little bit, but then started to pick up and hit max velocity during the pandemic, where it was truly back in the mix as this cool thing to do. And we're all sitting in front of our computers trying to buy and sell. There happened to be a time where the grading companies weren't adding more cards because they stopped grading for a little while and the prices were going through the roof. So then people started realizing, oh, this is a way to make money in a very short amount of time. So this gains velocity. And now what we're seeing here in 2026 is a $50 billion industry. And that's the reported number. I can imagine this being larger because the transactions that happen between dealers at card shows aren't able to get tracked necessarily. But this projection from $50 to $90 billion here in the next 5 to 6 years is definitely the track of this trading cards moving in the right direction, not just in the US. Now it's starting to be global, and you're starting to see some big companies getting involved in this arena. And so I wouldn't be surprised as we move forward here that we start seeing some mutual funds or ETFs that are a collection of these cards, and people are actually using this in their investment portfolio, not just in their personal collections. Okay, but what we're going to be talking about here is the 3 types of investors. Okay, so we're going to break this down. We'll add in some of the behavioral aspects here, some of their motivations. And first one, this guy who goes straight to the bar area that has all the unopened packs, he gets the box. That's the gambler. This is the gambler. He treats cards as excitement. That's what he's looking for. He might have a belief that he's going to get rich from this, just as somebody feels like they might get rich from going into a casino, but they're there essentially to maybe get rich, or they think they will, but they're there for the excitement. They're there for the dopamine hit that they get when they get a rare card, but it's all about the hunt. Knowing, maybe they know, there's varying degrees of how much they know that the game is stacked against them. But the way you open up, if you were to open up a box, you're going to pay $1,000 sometimes for these boxes. And on average, your actual value that you might be able to get back is a fraction of that. I'm going to even take a generous guess and go half of the value will come back from these boxes. But basically, a lot of these cards just become worthless, and you can buy huge boxes of these base cards for next to nothing these days. So this gambler is sitting at the table, and a lot of times at the sports card show that I go to here in Indianapolis, sports card store that I go to in Indianapolis, they actually have, it's an old restaurant, so there's a bar area, and guys like literally sitting up at the bar, and they just kind of flick them away when they don't get what they want. And then it looks and feels like a bar. Guys just sitting there, instead of sipping on their drinks, which are only like, I don't know what, $5 to $10, they're literally buying I heard a guy say, yeah, I'll take another round. So another round to me is, okay, another $10. And the guy said, okay, just put the card on. And it was $1,400 for another round. That's what that meant to him. And they just gave him another box and he started again. Holy shit. Like, I am in the same store, but this guy is here as if it's this casino, and just super, super interesting. He's there for the excitement though. So why would he do this? What would get him there? Obviously, he wants to have the big hit. So there's an element of some overconfidence. So this inflated ability sometimes where you feel like you have an insight. Maybe I feel like that's the box that's going to have that one of one card, that rare card. And maybe he feels through his overconfidence that this is a money-making way, that at the end of the day, he'll turn a profit. There is that. There's also some availability bias. So maybe availability bias is recalling things that are more available to us. So information that is more available to us. So this could be in his world. He was watching a guy on Whatnot or on TikTok, and he just pulled a rare card in this set. And so he feels, oh, this is definitely a real thing. If it can happen to him, it can happen to me. And so he might have that aspect working in the back of his mind as well. And then these cards, the way that they reward people opening them is through this variable rewards, something that we'll talk about in depth a little bit more later. But essentially, what you're trying to do from a reward standpoint, if you want somebody to pay money for it, you're going to give them the occasional small reward with an even less occasional rare big reward. So just enough to keep the drip going, to get them to keep going. And this is it's called variable rewards. And this is how casinos operate. This is how, if you were playing any sort of casino game, they try to stagger in these variable rewards, small, big. It's unpredictable, but it's kind of following some of those patterns, small, big. And you see the gambler, and man, they are paying a ton of money for some of these new cards. And so, yeah, I feel like that's, where hopefully you sense where I stand on that, especially with these new cards where they have one. I think 5 years ago, Trevor Lawrence, my son's favorite football player, trying to find a rookie card of his, and he had nearly 600 different variations of rookie cards. And I'm looking back here again. I've got my '86 Fleer, a couple Stark Hall of Fame cards here in front of me, and I was like, there's only a couple of Charles Barkley rookie cards that I know of out there. Most of us agree that the '86 Fleer is the standard. They can't make a standard rookie card. They can't make more of them. They can't go out and produce more of them. And there's only a couple of different variations. And we all agree it is this rookie card. Today, it feels totally like late 80s, early 90s, just in a different way. And so obviously, I stay away from the new cards and ask you to think about the same thing yourself. Number two, a second type of investor is the collector. Okay, so the collector, his motivation is not necessarily built on wealth. He's not trying to build an estate. He knows that, yes, if I hold on to it, these cards tend to increase in price, but his main motivation is going to be nostalgia. And so his motivation is happiness. So that's the nostalgia effect, is maximizing his happiness. And so you've got the gambler who's trying to maximize their excitement. You have the collector who's trying to just maximize their happiness. And that's where we have the nostalgia effect. We see people who tend to do earlier cards and that grew up in their childhood. That definitely is why I started '86. I got an '86 Fleer basketball set in my stocking in Christmas because it was $5. And so that meant Michael Jordan rookie card. And so there's a sense of nostalgia bringing you back to childhood that gets you involved in this. And that's why we pay extra money for this. You'll even see bands. Some of the bands come back and go, wait, I thought they were totally long and forgotten. No, we have this nostalgia effect. And now when you're in your 40s, you finally have money. And so the bands go, yeah, we'll do a tour. And people pay way more than they would have ever paid when they were in their 20s. That's the nostalgia effect. We also have this endowment effect. So people, once they receive something, they give it immediately more value. And so if somebody were to try to ask this guy who bought the Mahomes rookie card for $500, he's going to immediately value it higher, and he's going to have a real hard time letting that go, certainly for anything less than $500. And so these are also collectors that are really tough to buy from because they really value what they have, sometimes more so than what it might look like on paper. And then the final component, in addition to this, is sometimes people will put their identity into their collections. So you could say, I'm a Michael Jordan collector, or I'm a blank collector. I collect in New York Yankees collection. You can see, you can put your identity on that. So if you're trying to find some good deals or trying to buy any of that from that collector, you're going to have to rip it out of their dead hands in order to do that. So you have that collector who maximizes their happiness. Third is you have the investor or the flipper. Now I'd group those together because the investor could be long-term or short-term in their time horizon. The flipper is the short-term investor, but the investor is maximizing their wealth, and they're trying to just take any advantage of mispricing that they have in the market and earn a profit at the end of the day. And they're looking at supply and demand. They are looking at trends and trajectory of what's popular, what people are buying. And again, just trying to find some mispricing. So what I found when I was just starting to look back at cards a couple of years ago or a few years ago, started noticing that the ungraded cards, if you were to buy ungraded cards, that they happen to be a little bit more underpriced because of some ambiguity aversion. And we'll talk about that later. But people were hesitant to buy the ungraded cards because it was very ambiguous on what they would actually grade and how they would get graded. But once they get graded, then everyone has a standard. Here's how much it'll be graded on a 1 to 10 basis. Okay, so I have a graded card here. You send them in to get graded to this overlord who is in charge of all the grading, and they will give you a ranking of 1 to 10 on the cards here. And basically once it gets ranked, then there's a market that fluctuates, so there is some risk, but at least now we know this is an 8 out of 10. These are how much they usually price at, and then there's a market for that. So I noticed that as long as I'm willing to put in some of my money or my investment to get these graded, then overall, you're not going to win them all, but overall, your value increases and you can sell those graded cards and then redo the process. Take that money, put it back, restart the process and go and continue to go. And now this company, PSA, which is the predominant grader in the area, they actually have a vault. So instead of me getting the graded cards back to, my wife gave me a closet that is really well organized and has its own little organizational system that I can post stuff on eBay, sell them, ship them out. I don't have to do that now. They go straight to the PSA vault and they facilitate. I say, here's how much I want to sell it. Or I could sell it to an inside dealer, which is a whole nother conversation we can have. But I could sell it and I don't touch it. Basically, all I do is I go to my spreadsheet, I update my inventory, update my numbers. They make the payout in the next couple of days, and that's it. So it's no wonder why this is really picking up momentum and steam and making some money at the same time. So anyway, some of the things that I have to think about here again, is this herding? So making sure that, is this gaining in popularity? Because if the herd goes away and nobody wants to buy or collect these cards, I have to remember at the end of the day, there's no real other utility for these besides anybody else wanting to buy them from me. So these are just pieces of cardboard. I have to remember that at the end of the day, and that it's only predicated on somebody else's willingness to buy these. And that's kind of what draws me away as an investor from this and go, this is so fucking stupid. What am I doing? Why am I so obsessed with this? And again, that's why I usually try to throttle any sort of inventory back to 1% of my overall net worth, maybe 2 at the max. But that's kind of where I'm at with that, because at the end, there's a lot of time involved in it. So anyway, herding, recency bias. So what it recently traded at, sometimes we assume it's going to continue to trade at that price, even though we know that could just be a flash in the pan. And by the time they get graded and they come back, which is now like a lag of over 6 months, it could be a totally different market, for better or for worse. And then also, once you get some wins, you can develop some overconfidence in this as well, going, I must have a really good eye for these cards, and now I don't really even need to put these under the microscope before I send them in, because I just know that it'll always work out. And that's where you can get burnt sometimes as well. Okay, so once again, as we recap this, we have the same asset, which in theory, if you were to look at economic theory or financial classical theory, we always believe same asset, we all have the same utility function. So we all have the same motivation of happiness, and we treat it and measure it all in the same way. Behavioral finance, that's what we're here for, says that's not true. We just showed you we have the same asset, and we have at least 3 different motivations around this. And when we say motivation, if you tie this into academia, it's the same thing. That's utility. We have different utilities. So whatever brings us happiness, whether it's excitement, could be nostalgia, or it could be wealth. You have 3 different motivations. That's what makes this topic super fascinating. Now, we can take this outside of trading cards as well. People have different motivations if they buy their house. This is where I'm going to raise my family, or I'm going to flip this house. You see this in different areas. So nice watches, shoes, purses. You see all these different asset classes or different areas where you see this kind of behavior, in addition to stocks. That's a thing as well, where we see the same types of individuals dealing with the same assets. And so that's where we're going to leave off, that people don't just make purchases. They might purchase this for hope or excitement. They might purchase this for security or wealth, or they might just purchase for nostalgia or status or identity. And that's where we want to start thinking about ourselves. Where do I stand on this asset class? Is that okay? And then also, if we're helping other individuals, we want to understand that from their standpoint as well. What is their psychology? What's their motivation around that type of purchase that they make? And anyway, I'll leave it at that. I hope you like that. It's just that I feel like it's a really interesting way of looking at things from a different perspective. And it starts to give us maybe a little bit of a framework as well on how the 3 different types of people are motivated. All right. Thanks for watching. If you liked what you heard and want to hear more, hit that subscribe button. Please, if you have a nice thing to say, would love to hear that. Comments always help out. They add a little grease to the algorithm, gets more viewers, more listeners to understand their financial decision making, and hopefully make behavioral finance a very popular topic. If you want to reach out to me, you can find the links below, and would love to hear from you. Thanks, everybody. Have a great day. See you next time.
Thank you for tuning in to another episode of the Bryan Foltice Behavioral Finance Podcast. We hope you found our exploration into the fascinating world of human behavior and finance both enlightening and thought-provoking. Be sure to subscribe for future episodes. And until next time, stay curious and financially savvy.